Let's get this show on the road. Good to see you, ladies and gents. What time are we? 7 o'clock UK time. The clocks have gone full back. Yes, of course it is. Full back in the UK. We are 1 hour out of sync with the American market at the moment. Yes, so 1:30 is the open, 8 o'clock is the close. Thank goodness only a few more days of that. My calibration's all out. It's 1 week. It's so simple. But when you've been trading like this and there's always a 2:30 open and your whole day revolves around that for 20 odd years, then just a little shift tends to upset the apple cart a bit. So anyway, we are GMT now in the UK. Americans will change their clocks Sunday, Saturday, at the weekend anyway. So we're back to in line with stuff on Monday. Here's how we'll do things today. Thank you so much for joining me. If I haven't already, it's a pleasure to have you here. We're going to be talking about deciphering market rhythm. Let me just check I've got everything set up. I think I have. You should be able to hear me loud and clear. Today we're talking about deciphering market rhythm. And what we'll do is what we've started to do now with these webinars, kind of mix things up a bit and add a bit more flavor to things. Is we'll hit the charts in a moment, spend a little bit of time looking at what's happened, maybe some ideas, maybe some patterns that we're observing, and kind of go with things that are happening right now. And then we'll flick back to the slides, and then we'll go through deciphering market rhythm. And then halfway through there, I've got some chart examples that are always best when we're actually sharing trading view, as opposed to cutting and pasting them and putting on the slides. We'll go back to that and kind of highlight some of the examples that I wanted to cover. A quick note, if I look like I'm a little bit in pain, it's because I am, right? Story for you. Went swimming yesterday, and my daughter said, who's doing GCSE PE, said, "Dad, I think I've got to do butterfly for GCSE PE." I said, step aside. Let me show you how butterfly, you know where this is going, how butterfly works. Come on, move out of the way. So butterfly, half the length. And if you know what butterfly is, it's kind of like a really difficult stroke. When you start kind of plodding around with your front crawl, your breaststroke or whatever, just to go from cold to butterfly. Yeah, I felt it in my shoulder. I came back, I was like, that's how you do butterfly. And she was like, "Oh, thanks, Dad." As she was going down, I was like, my shoulder. So it's not the end of the world. It'll be all right. But lesson, don't try and do butterfly when you haven't done it for many, many years and you're not warmed up correctly. Anyway. So it's by the by. You care about that. You care about trading stuff. Listen, I was talking to before we hit the charts. I was talking to a fellow trader about consistency, because trading is all about consistency, right? It's consistently sticking to your plan, even when it's boring and you don't want to. You've had a rough day, things aren't going your way, and every fiber in your body wants you to deviate. It's consistently logging your trades, not just the winners, but the ones that you totally screwed up on. Consistently auditing your performance and saying, hey, did I follow my process? Did I size correctly? Did I let my emotions creep in? And the traders who have a good chance of making it long term aren't chasing like a new strategy, a shiny strategy, or the next setup, the next play. They're mastering the same approach, right? They're refining it, reviewing it, tightening things up over and over until it becomes second nature. And that's what compounds in this game. It's not luck. It's just that quiet, relentless consistency. Because if you can be more consistent when everyone else is being impatient, that's when you've got a good chance of tilting the odds in your favor. I thought I'd mention that because I think it's something to consider. Consistency is, it's that slow, steady pressure in trading that compounds over time, that builds and builds and builds. And listen, we're human beings, right? We're impatient. Of course we are. But if you can put that impatience to one side for now and just focus on consistency, regardless of the outcome, then you look back and go, hey, that was all worthwhile. Okay, so let me share the screen now, and what we'll do is we'll hit the charts, see what's been going on, see what's been happening, and we can move on. Man, we've got a lot of interesting stuff coming up, right? Okay, should see that. Right, I suppose I should do this first. The disclaimer, the risk warning. You know this by now, guys. You know this. But I like to say it, and I think it should be said. Obviously, you're trading a leveraged instrument like a spread bet, like a CFD, or any product indeed, really, where you're using leverage, you're using margin to trade on, please be careful. Please be warned that it's great when things are going your way. You're sized up, things are going way, woohoo, whoopie-doo, it's all nice and land of milk and honey. And when things, risk happens fast, right? Things can just rug pull, you have a tweet come out, anything come out. And if you're over leveraged, using leverage, you're trading on margin, you can lose a lot very, very quickly is what I'm trying to say. So be very, very careful. Understand the product you're trading, the instrument you're trading, know how to manage risk with stops, with size, your gap risk, your slippage, all the other stuff that comes into this game. And obviously only trade with money that you can afford to lose, please. I just hate to hear stories of people who didn't really actually comes back to the impatience thing, right? Oh, I'll just trade a little bit more size. This is definitely going to work, this trade. And trading is a numbers game. We're playing the odds here. We're looking to trade that. Would you take that trade 100 times? Not that trade is going to work. It's like, okay, is this setup? Does this setup have efficacy at a positive expectancy over time? And so because of that, be very, very careful of the risk that you're taking in trading. Okay, good. Right, we can get rid of that. We can move on. So let me look at my notes. Because we've got a few things coming up. One thing I wanted to mention, let's look at the Nasdaq, shall we? Look at the Nasdaq. If you hadn't guessed, this is a bull market. And regardless of what you think of the market, it's a bull market, right? The market keeps going up. The market shrugs off bad news, sign of a bull market. We had the bad news on Friday. Bad news. Trump talking about China and this, that, and the other. And that was the other Friday. We kind of consolidated a bit. We talked about in the last webinar of how that needs to be resolved at some point. We did then break out last week, and we kind of closed highs, right? The breakout was there, and that to me was indicative of, okay, fine, he backpedaled. There was loads of stuff what he talked about. We'll sort it all out, as he always does. The playbook has been the same for many, many times. But a lot of people are fighting this trend, and there's a logical argument like this is overpriced, that's overvalued. That's fine, but I would urge you not to jump the gun trading short. Like, unless the market confirms you're short and starts to go down, picking highs is a losing game. I promise you, I've been there. I remember years ago, early 20s, FTSE was just chugging along. I thought it's coming to, I remember it now, comes the end of a year. I thought, nah, this is way too high. What did I know? 20-something-year-old kid who's a trader, shorted the FTSE, got stopped out. Shorted the FTSE, got stopped out. Shorted the FTSE, got stopped out. So many times, and December was awful. And I looked at it and went, why am I doing that? Why have I done that? Is that a strategy that you've kind of been building? Is it many meaningful? Why do you think you know better than price? Price is going up, and it could continue to go up for another week, another month, another year, another decade, 100. You don't know. If you want to become a price trader, you have to have price as your North Star. You have to pray to the Bible of price. And if price is continuing higher, especially if it shrugs off bad news, that's the way it is. Now, could it shift tomorrow? Of course it could. But if you are thinking of trading counter trend, if you're thinking of fighting this stuff, come up with an idea of what you want to see before you even do that. And I would, think clearly and carefully about, it's like the most hated rally in history. I wrote an article on that a while ago. And I even saw this before I came on. I want to show you this, guys, before I came on. Where is it? We are bizarrely, I don't know if you can see this, hopefully you can. We are bizarrely, that's not what I wanted to show you. I scrolled down too much. We're the fear and greed index on CNN. Fear. We're at fear. We're at highs. It's like this is bizarre. So and this doesn't, normally we'll have greed, and we have the greed, and we have the euphoria, and that's what causes the market to rebound, retrace back. So anyway, the summary is, I'm not here to tell you how to trade. I'm not here to tell you the market's going up or down. I don't know. I'm following price, but just to save some people who are maybe making the mistake of it's too high, it's too high. I remember when the Dow was hitting 10,000, people wearing caps saying 10,000, and it was like, oh, it's way too high. Look at the Dow now, right? 10,000 is a mere blip, so just bear that in mind. Just if you want to be a price action trader, then use price, and just look at what's happening, and put your preconceived notions and intellectual and smart ideas to one side and say, listen, this is what's happening, because actually this is what fuels price. You know, we have a lot of people shorting. They have to cover when it goes to new highs. That creates fresh buying. There's kind of a drip feed of buying anyway. People who may not be fully allocated in equities, then going in. So there's a lot going on. Right. That's that being said. Hopefully that saves a few people who are shorting this. Now, that being said, I don't know what's going to happen tomorrow, the next day. Who knows? But the point is to wait until you see something that makes sense, i.e. the market goes down, maybe then it tries to recover and then it rolls. Who knows when that happened? Could it happen tomorrow? Maybe. Could it happen 10 years down the line? You don't know that, but that's the point. It's kind of waiting and being strategic, you know, and trying to find a high probability trade as opposed to what you think is going to happen. All right. What have we got coming up? Some notes here. Got Fed tomorrow. Something to look out for. We know what the expectations are for that. Do we expect price to do much? Again, these are potential catalyst points of a reignition and a kind of second leg up, or do we stagnate, or does it cause some sort of unwinding back? And by the way, a bull market can unwind a reasonable amount and still be an uptrend. You know, a lot of people jump on the first couple of red days. It's like, hang on, just let things mature. I'm talking about NASDAQ here, by the way, and US equities specifically. Fed, GDP on Thursday, another selection of stuff on Friday. Now, we also have to add to the mix. We've got earnings from aftermarket close tomorrow. Microsoft, Meta, Google, and a couple of little tiddlers, Starbucks, eBay. Thursday, we've got Apple, Amazon, things like Coin, etc. So big week for macroeconomic data, big week for earnings. Could it be a catalyst for a shift in sentiment? Maybe. Could it be a catalyst for reignition? Could be. These are often points to watch. And what I think is important is how the market responds to good news, bad news. If you're a NASDAQ trader, Dow trader, S&P 500 trader, is what happens if we get something out of line, out of sync. The most likely scenario, by the way, is all of these coming in line or as expected reasonably, and the market carries on, resumes its normal uptrend. That's the most likely scenario, but things can change. So that's worth kind of looking out for. Okay, so where are we? We're gapping up. Gapped up, obviously, on the news that there may be a trade deal with China. That's coming up. Now, listen, I'm not a fundamental trader by any stretch of imagination. I don't think I can outsmart some of the brightest minds in the world who research this, understand this. But I kind of want to know what other people are looking at, why they're making price decisions, right? And I think that's a missing piece of the puzzle for many traders. And today we're going to kind of talk about this rhythm as well. But I think that it's important to know what's driving the market. What's the market's engine? What do people care about? What's the response to bad news, to good news? Because that gives you a glimpse into who's really in charge. You know, that was a really heavy down day that day where Trump was bashing China on Truth Social and on X. And we kind of sat there and we didn't know what to do. But ultimately, we kind of resumed back up. And you kind of say, well, actually, theoretically, the situation is still not good, but actually we're significantly higher than we were, and that kind of gives you a little bit of insight into who's in control, who's in charge, and obviously just looking at the price, right? Gapping up, moving high, closing at highs, next leg, it's flushing out a lot of sellers. Not say it can't go down, but that's something to consider. And also just remember, just going back, if you are looking at price, all-time highs, you know, you can look back and say, oh, you know, it was a while back. You remember COVID? If you were trading during COVID, everyone was like, oh, 10,000 NASDAQ. Look where we are now. Like, forget about the absolute numbers and just look at price, because that'll help you so much intraday, on higher time frames, etc. All right, so that's what I think about the US markets. Bull market until otherwise. Could it retrace a bit and unwind? It probably will at some point. Super stretched. Probably needs a bit of retracement, the consolidation. Does that mean it's the top? Probably not. Let's see what happens. Okay, one other thing to look at, I think is interesting is, where is she? Gold. It's gone to CFD. Gold is, get rid of this. Gold is kind of really an interesting territory, right? We had really big blow off top, kind of massive pullback, and it's unwinding. Now, I think the scenario here for gold is, personally, and maybe you disagree, personally, I think it's difficult now to judge what will be the kind of the resolution from this. We could just sit and stagnate, and that's sometimes that's a third scenario that most people don't consider. Bizarrely, it goes up, it goes down. We could just sit there and do nothing. And so something to consider for gold is it just sits here and does nothing. So good intraday trading vehicle, I think, but swing trading vehicle, For me, I don't know whether we kind of push back up to the 14,200. Do we kind of sit here and consolidate? Is 4,000, sorry, 14, is 4,000 become a magnet? And we've got kind of lots of options, expiries around that kind of level. I don't know. I think that the meat of the trade is probably done. Let's see how it resolves. Crude oil is catching my eye at the moment. Why is crude oil catching my eye? Because let me go on a daily chart for you guys here. It's really under a lot of pressure, right? And we've got this situation where obviously the sanctions on Russia caused crude oil to spike here. How it resolves from that is going to be telling. Just like we saw on the flip side from the NASDAQ resolving to the upside, if crude starts to kind of push down below these lows that we saw before those sanctions, that will be interesting. That will be telling. That will be like, okay, the sellers are in charge here. At the moment, it's pulling back a bit, fine. We're still in no man's land. And this is kind of, I think, the key to reading price is to say, what's meaningful? Yeah, we gapped up as expected on the sanctions thing, fine. Price is going to go higher. This is a kind of fundamental supply and demand shift. We get it. It's a reprice. What happens then? What happens then if we continue? There's obviously people are scrambling to buy crude. They're looking to top up their inventories, whatever the institutions do and the commercial interest is, fine. If we start to rock back, still with the sanctions, that's telling us something. And I'm really interested, not at the moment, not yet, but I think if we start to kind of do some business under that low, you know what, that could be interesting. That really could be interesting. Could be a catalyst that kind of causes a bit of a cascade lower. Of course, when you look at something like crude compared to, say, NASDAQ, Tesla, all the other stuff, you've got a supply demand shift, you've got production, you've got consumption. It's a slightly different animal, and I don't claim to be an expert on this, but thinking about commodities in a slightly different way, especially with OPEC, who can turn the taps on and off. Trump obviously wants lower oil. He wants to kind of seize up the Russian oil machine. OPEC want reasonable oil where they're making some money. There's a bit of a conflict there that you don't get in the kind of currency markets or in the equity markets, but something to consider. That's definitely on my watch list. Obviously, US markets from my watch list. Oil, like I say, gold and silver, but I think as intraday trading vehicles or 1 to 2 day vehicles rather than thinking of a swing. And you know what? The currencies were catching my eye, not catching my eye so much. I want to see them resolve a little bit. I'm not a huge currency trader anyway, but maybe you guys have got something there that you're interested in. So those are my thoughts on things. We'll come back to the charts in a moment. We'll talk about more intraday stuff and rotations. For what it's worth, like I said, I don't claim to be some sort of amazing expert on the future direction of stuff. I really respond to price, and I can change my mind, in an hour or so, depending on what's happened and what's happening. But this week's got a lot of stuff coming up. We've got Fed, we've got some earnings, we've got bits and pieces. So I think it'll be interesting. And regardless of the way you trade, whether you're swing trader, intraday trader, whatever instrument you trade, even if you kind of don't want to get into the fundamental stuff, I get it. I understand. I'm with you. I don't think I can outsmart some of the brightest minds in the world, but I do want to know how people position after perceived good news, bad news, neutral. What happens to price after that? It's like we're talking through there. Because I think, well, I don't think, I can't say, I never say I know, but I believe, let's put it that way, that gives us a true edge, because then we kind of, as a rising tide lifts all ships, if it's kind of falling, we kind of can align much more effectively as short-term traders with how the institutions are potentially positioning. Don't forget that you have to ask yourself the question, I'm rambling on it, but it's important. You have to ask yourself the question, why is someone going to buy after you've bought for price to go up? It's not just a pretty candlestick pattern, right? That doesn't make sense. It has to be more than that. And so whilst the candlestick patterns help us, and technical analysis helps us time trades, structure risk, structure targets, all of the good stuff that we know and love, institutions are being driven by their thesis on the market. They're being driven by different kind of forces. We need to get in on this rally for the year end. We need to make sure we're doing this, or we need to position here. And we don't know for sure, but if we can get clues and we say, hang on a second, we think there's some money coming in, we think people are getting squeezed on the short side, this has revealed the true extent of supply demand imbalance here, then that maybe helps us, whether we're trading intraday or kind of multiple days. Hopefully that makes some sense. Okay, so let me share this. I don't need to share the audio. You can hear me already. Let's go. Okay, so back to the topic in hand, why you're all here. Hopefully you find that valuable. It's a new thing we're doing. Done these webinars for a while. If you're new here, New thing I'm doing, just kind of looking at charts and just talking through some stuff that's going through my mind. Is it actionable? Maybe not so much, but just some thoughts, and maybe it'll help you to a certain extent. Okay, so let's talk about deciphering market rhythm. So what we really want to do here is, in fact, let me kind of move on. Let me move on. So deciphering market rhythm, turning market tempo into actionable trade skills. So here's a quote from George Taylor, and I would give you the book, but my trading buddy Imran has nicked it and he borrowed it. He's not giving it back, and I've asked him for it back, and I'm going to get it back off him because it's a great book. So George Taylor, he was an old school trader like Wyckoff, that type of thing, and he kind of came up with this 1 to 3 day method. And we're going to go intraday here, so it's slightly different. But his point was there's a rhythm to the market. You get these buy days, sell days, as he called them. It's a great book. The first part's really tricky. I wouldn't even bother reading it. The second part's really useful. And our job is to fall in line with that, fall in step with that. And so today, in the next kind of 30 minutes or so, I want to talk about how we read the intraday rhythm. How we get in tune with what's going on intraday so that we can capitalize on the structure of the market, the flow of the market. Because how many times have you taken a trade, right? And you were just a bit early. And a bit early means you stopped out. You've got the right idea, it's bottoming out, but you're too early, you get stopped. Or how about you're too late and fine, it works, but you stop so wide, the RVR of the trade, as we talked about last week, the asymmetrical trade idea is nowhere near as good as it could be. So whilst we're not here to say, hey, we're hindsight, we're going to get the low of the day and all this type of stuff, I think that we can do better, and you'll see in a moment, when we can really map out the rhythm of the market, the flow of the market, and use that as a tool to guide us to our entries intraday in the next sequence of the trade might offer. When the market, with next rotation, the market may offer. And this is not something, I often say this, but I kind of, the reason I share stuff with you guys is I share stuff that, is front line, if you like, insights, ideas. Will you read this in a textbook 101 stuff? No. Maybe there is somewhere out there, of course, maybe, but this is not like a typical stuff, and so maybe it seems a little bit unusual sometimes. Maybe it's a little bit I don't put it across as eloquently as perhaps some of these guys who are great writers, but the way I look at this is like, I want to give you stuff that's valuable. I give you stuff that I think is going to help you with your trading, and I believe this is going to help. And so whilst it might be a little bit convoluted, a little bit out of sync, and a little bit mismatched, hopefully with this and the recording that you get sent, you can make some sense of it and you can apply it to your own trading. So that was Taylor, George Taylor, great guy. We talked about disclaimer. Okay, so think about this, right? If you've ever been surfing, it's been a long time since I've been surfing, super long time, but you have been surfing, kind of know how this works, right? You get a swell. If you are kind of too close to the beach, you're in the white water, right? You're not catching the wave as such, you're just in the white water. That's fine if you're a kid and you're bodyboarding or whatever, but if you're surfing, you want to get up and do surfing, you want to be out and catching the wave as it breaks. If you're too far out at sea, then you're just going to be bobbed up and down because the wave isn't ready to break yet. Simplistic example, but this helps you visualize. We want to be right in that point in the middle where the wave is breaking and a bit of energy can get you onto the wave and you can enjoy the ride and you can get up and do whatever, right? And it's the same with trading. Like to a certain extent, you need to calibrate. So when you go out into the ocean, you swim out through the right water. My terminology is way off here. Surfers, apologize. But you kind of get to see, hey, the wave's going up and down. I need to kind of wait for this, and you kind of adjust. You kind of move back a little bit, you move forward a little bit. The bigger the wave breaks a little bit earlier, so you kind of, as it's kind of, you see it building, you kind of move yourself out towards sea so you can try and catch that. You adjust and calibrate based on what's happening now. You don't really care what happened yesterday. You don't really care what happened last year, what the forecast says. You're out right there looking at the actual swell, trying to catch the wave, and so you position yourself accordingly. If you get it right, a few little paddles, you're up, you're away, you're enjoying the wave, you're enjoying, you're enjoying surfing. Get it wrong, too late, you're gonna get mashed, into the sand or into the coral if you're out doing somewhere exotic. Too early, just the swell is going to bob you up and down. Same with trading to a certain extent, is that the rhythm changes, right? We get these rotations, we get specific repeatable patterns that occur, but it's not going to be forever. Like, it will shift. You will get these little patterns, as we'll see in a moment. We'll hit the charts in a moment. You get these. I never want to use the word predictable because it's such a cheesy word and it's not true, but can't think of anything better word. Reasonably predictable. Nothing is 100% predictable, of course, in trading. That's why we have a stop loss, why we manage risk. But we get the same thing again and again and again. And so we say, hang on a second, whilst everyone's worrying about back testing 20 years ago and doing this, I'm looking now, I'm in the ocean now, I'm seeing the swell now, I'm seeing the rotations now. Let me map them out. How does that help me position for the next hour, the next 15 minutes, the next rest of the day, whatever it is? How can I use what's happening now, the price action right at this second, the rhythm right at this second, the context right at this second, to assist me in my trading? And this is stuff I think is super overlooked because everyone's talking about going back and testing this and testing that. There's nothing wrong with that. But if you're a trader in the trenches trading most days, not be every day, but you're there, you're looking at charts, you want to leverage on that. If you're putting the hours and the work in, why waste it by doing something that doesn't align with what you see now? And it's not always going to be there. There's sometimes you're going to see patterns, that's a pattern. I'm going to risk capital on that. There's no reason not to. My risk is X, my reward is 3x, 4x, hopefully something like that. Why don't I do that? Okay, let's kind of talk through what we're talking about here. So every market breathes in and out. You get a tempo, you know when to push, when to wait. It's not about predicting, it's about syncing with the flow. So the skill we're trying to build today, ladies and gents, is this. Know when volatility is potentially expanding or contracting. Build a better understanding. There's a 4 in there. I don't know why I put a 4 in there. Build a better understanding of price rotations and try to time entries and exits around the market's natural heartbeat. Okay, 4 things. I'm going to do 3 actually because four is there's some similarity with this. Here's how I believe you read the rhythm and the core tools, and I'll show you this, and hopefully a little light bulb will go off and you go, yo, Mark, you know what? I quite like that. I'm going to use that. And honestly, I think if it resonates with you and you start to use it in your trading, you'll find value from this. So let's go. One is rotation mapping. So rotations, what I mean is the market going up and down, up and down, up and down. Pit traders used to call it rotations. They would kind of trade these rotations. They would look for 3 handles up in the S&P, 2 handles down, 3 handles up, 2 handles down. There would be a kind of natural rhythm. That still happens now. I will show you in a moment how we mark that and how we use that to future pace where price could be and how price could react and where the swing point could possibly be next, using what's happening now, the context, the current swell, the current conditions as our roadmap, rather than something from a textbook or something from back tested 1,000 years ago and kind of has efficacy but has once gone through a 15-year drawdown. Yeah, great. Okay, 2, VWAP distance from VWAP. This is something I talked about before. Ironically, it was the least watched video I think I did, a webinar I did, and sometimes I'm like, this is the most valuable for you. I promise you, try it. So we'll try that again, and hopefully these will see some value from this. Range of volume change and reaction to big candles. Okay, let's go to the charts now. That is the slide that I'm going to use for this chart. Try to make this a little bit more effective. And apologies that we're back and forth sharing this, sharing that. But you know what? If it takes a few seconds of your time, I'm sure you will forgive me. Okay. Hopefully you see that. Let me get rid of this. And by the way, I'm looking at my other screen here if I'm not looking at the market. Okay, so chart skill number 1. Let's get down to this. Rotation mapping. And what we're trying to do here, we are trying to look at the rhythm of the market. And rotations is, again, what I mean by this is, and it will become clear in a moment, is the swing highs, the swing lows. So as we go lower and we rotate back higher, we go lower, we rotate back higher. Just the rotations of the market of price, testing high, testing, not like big extreme moves, not volatility driven, not catalyst driven, not reprice scenarios, not kind of breakout volatility, breakout stuff, just general rhythm, back and flow, backfill, ebb and flow markets. Okay, so how are we doing this? Drawing boxes around clear rotations, do it in a second. Note how many bars each lasts. When the rotation starts to shrink, we think that the shift might be happening. We'll talk about that and how we do that. When they widen, when the rhythm's slightly changing. Okay, so let me pick this day here. Okay, random day the last week or so on the S&P 500. I'm using the futures contract. Same with the CFD. Same with with your spread bet fee, whatever you want to do. Okay, so what I'm looking at here is let's just the context is important as well. Of course, context is important. Where are we? We're in the multi-week range. Nothing really much is happening. There's no real reprice scenario. We haven't really gapped anywhere. Let's get rid of that. We don't need that slide anymore. We haven't really gapped anywhere. We've kind of broken the low, but ultimately look where we're on the range. We're right in the middle of the range. So rotational market is fine. It's not like we've broken out. It's not like we had today, yesterday, new fresh highs, new run, catalyst driven, different rotational market. You guys know this, right? So what are we doing here? We're saying to ourselves, I can see this rotating up, rotating down, rotating up, rotating. How do I trade this? What do I want to do? And we might go, okay, what does the textbook say when I want to do this and want to do that? Fine, but I'm not saying don't use these things. And very, very good to have these trigger bars, these 1, 2, 3 reversals, these kind of flushes to the downside, etc., etc., etc. But we want to kind of get in sync and in tune with the conditions. So look at this. Think of this. Number one, duration of rotations. Number two, price move of rotations. That English isn't great, but you hopefully know what I mean. Like how much does price move and where does it change? So as the market starts to kind of sits there and does nothing, oscillating around VWAP, starts to break lower. Okay, so we start to use this tool on TradingView, which is the what it's called tool, price and time box, I guess. How long does it take us to go from kind of the high to the low here? So from the breakout point to the low, and we go, okay, it's about 5 bars, so about 25 minutes, 5-minute chart here, and we've done about 25 points, right? Give or take. Now I'm gonna, got a bit of poetic license here. We've moved down, so from the breakout point, if we go to the low here, we're about 24.5, yeah, from the breakout point to here. Okay, fine. Now, how long will it take us to kind of push back up from this point here? Well, you know what, we were a little bit quicker this time, but the rotation was still pretty much the same, 24.5 points. If you look at this, let me zoom in, hopefully you can see this. I'm assuming you can. Let me zoom right in. Let me zoom right on this sucker. Okay. It's never going to be perfect, but again, think of the ocean, think of the way the waves go. How 24.5 points, or it's called it 25. I don't like being super accurate like this. 25 points, it's about right. So we broke out 25 points to the downside, 25 points to the upside. We rotate back lower. How long does it take us to go from the high point to the low point? Well, you know what, we're looking at about, we were 25, by the way, before, 25 minutes. It takes us about 25 minutes, about. It's not going to be precise. And what's the rotational length? Well, it's a little bit higher, like it's a little bit more. But we're talking about the same order of magnitude here, 27.5 points, that swing low, about the same sort of time. So we start to map out and say, okay, we're seeing 25, 26, 27 point rotations. They're taking about 25 minutes, 30 minutes, right? You start to note that down. The trader's got his eye on the ball and is interested in kind of calibrating and maybe generating a trade idea from this. This is what you're jotting down. Piece of paper, right, these are my rotations. Okay, fine. How do we use it to trade? Now, are we always going to just use that as gospel? No, we're not. More interesting is this. We start to map out these rotations, the distance from high to low, the distance between the highs, the distance between there's a symmetry developed. They're going to be exactly the same, but there is a symmetry. You can see this symmetry, and go and check out any chart you want that's in a rotation environment, and there is a symmetry to it. And our job as a trader is to, like we say, we're out in the ocean, we want to see the symmetry, see where the waves are, where waves are. Okay, how long does it take us to go from low to high again? Okay, so that high point here, that low point there, let's put the box on this. It's going to be same sort of time period, right? It's 25 minutes. If you can see that, trust me, it's 25 minutes. 25-point rotation. So we've seen some symmetry. Okay, now, fine, if you want to trade that, that's bearing in mind that you only see this as it's occurring. So you need some time to see that symmetry. But now you've got it. Now you see 25-point rotations, about 25 minutes. It just happens to be 25, 25. I don't think there's anything to be looked into on that. Now, the next rotation is about 25 minutes. It's about 25 points. We start to push to this low print here from this high print here, down, high to low, 25 minutes. Now, this is where the shift happens and where us as traders say, hang on, things have changed. Maybe you're trading that rotation beforehand. Maybe you were shorting the VWAP looking for 25. Fine. The earlier you can get on board it, the better. What's more interesting is this. When patterns start to shift. And by the way, I haven't cherry picked this. This is something that was a rotational day last week or so. I've not gone, oh, this is the perfect example. I'm just showing you this is kind of some of the stuff that happens time and time again. When you start to then map out that low, by the way, you wouldn't know what's going on here. And this, let's assume, I know, let's assume that whatever this is doesn't exist for now. And you're like, oh, Mark, you can't do that. But just bear with me and you see what I mean by this. So, and basically with the rotations anyway, it would actually work in your favor. And you're like, oh, great, I made loads of, but forget that. So imagine the price now is starting to do this. It's starting to, instead of rotating back up as it has been before, it starts to stagnate at lows. And so your 25 minutes goes by and it's hardly pushed up. That is the shift then in sentiment that you need as a trader to say, hey, do I think we could push further lows? Yes, because the rhythm has changed. There was a natural ebb and flow and rhythm to things, and now it's shifted, right? So now you can bring out your textbook and say, I want to short through lows, I want to short the first pullback after new lows, etc., etc. The shift in regime, where does it change when you're mapped out the rotations? You've got two ways to look at this. One is the quicker you can get in tune with the rotations, maybe that's your trading style, A to B, and now you know how long to hold, you know roughly the target. So that guesswork has gone. You're like, hang on a second, we've pulled back. I've seen a couple of 25-minute rotations, 25 points in the S&P 500. Okay, I'll use that to my advantage. I may be short here. I see a turn here. My target will be here. And, I'm not talking about hindsight here, but this is the type of thing you can do. You're mapping the way you trade to the current conditions. And then when conditions shift, you go, something shifted. Do I want to position for that? Or do I want to stop playing the game that I've been playing, the rotational game? And that's kind of how the thing works. Because algorithms, institutions, money flow happens, and we do get this ebb and flow. We do get this ebb and flow. Often it's around VWAP. This happens to be under VWAP. Like I say, when cherry picking specifically, it's actually better when it's around VWAP because you've got a kind of mean to work off. But we often get these rotations back and forth, back and forth. And if you can just take the time to map them out, never going to be perfect, you can then know what's normal for the day, for that time period you're looking at, what's abnormal, and potentially how to trade the shift. Okay, next thing to look at is the VWAP distance. Let me get rid of this. Let me show you this. I've tried to be smart and put this in here. Hopefully you can see this. Skill number two. Hopefully skill number one makes sense. Skill number two, VWAP distance. When price is oscillating around VWAP, and by the way, if you're not using VWAP, I think you're missing out. I don't say about many things. Honestly, I think it's one of the key. We've researched it loads, done lots of studies on this. Other people have done studies on this. It's like a benchmark for institutions. I think if anything's going to be on a chart, it should be VWAP. Your choice. You're never going to tell another man or woman how to trade, but I think you're missing out if you don't put VWAP on. Many of you are, so that's fine. When price is hugging VWAP, that tends to be indecision, right? Balanced rhythm, scalping environment, if you want to do that. Not for me, but fine. When it's being stretched away, often you kind of, if it's continuing, then it could potentially roll into a breakout. You might get kind of urgency, supply demand imbalance shifting. And what we're trying to do here is we're trying to measure how price, without, and again, I'm not like Mr. Precision. I'm not going to sit here and measure stuff and go, well, it's 2.25 points away. I'm not interested, right? I'm a trader. I understand that things have a tendency. There's a tendency. And I think that's the shift that's worth doing as well for you, is like, okay, the market tends to do this. When we break out on gap to highs, we tend to do this. Can it always do this? Will it always do this? No. But if I line with that and then frame trades from that, I think that helps loads. So VWAP distance. We want to try to combine the move away from the VWAP and these different types of day with the time of day to help time our trades. And that's when we use our traditional kind of timing mechanisms, the ignition bars, the flushes, the reversals, the stuff that we know and love. But if we can map that with the rhythm of the rotation rhythm we did in one, or a VWAP excursion two. Now, the way I like to look at VWAP, by the way, is most of the time acts like a magnet. When price goes above VWAP, and I don't know if it's about VWAP, I've done a whole presentation, webinar about this. It wasn't a presentation, webinar about that. So you can dig into that if you like on my website, Because tradersmastermind.com, go to trading strategies, it will be there somewhere, or the webinar section. I'm trying to kind of collect everything up and make it a little more of a useful resource for you. So what we're trying to do here is we're mapping distance away from VWAP. And don't forget, let's look at this day here. What day was this? 17th of October. Okay, so not long ago. Rotational market context, super important. We're not taking things out of context. The context is fine. Rotational market, multi-day range, no big deal. We're not repricing. That's important. Context is important. Okay, so what do? We start to map out and go, how far do we move away from VWAP? And VWAP here is the white line, if you didn't know. Let me zoom in even more for you. I don't know what you can and can't see. And all I've done here is taken the price range distance tool, whatever platform you use, it'll be on there. What's the distance away, that we went from VWAP? Okay, so we're about 140 odd points away from VWAP to the high side. That was early on as well. So we start to map that out. I will drop that down. How far away from VWAP have we gone before we start to rotate? Now, is there a trade from there? Maybe there is, but not for this yet. Okay, fine. That's the rotation. Now, I want to see how far do we go under VWAP, right? And if I can add extra layers of edge into this, I can start to, whilst this is not something that says, yeah, go now, pull the trigger now, this is an amazing trade. No, it's about these themes, right? And if we say to ourselves, context, rotational environment, haven't broken multi-tool day high or low, we're still waiting for news, we're still waiting for stuff to go on. Market pushes to one direction, about 140 points, and I'm on the NASDAQ here, by the way, starts to come back to VWAP, rotates the other way, and now it starts to do about the same distance away from that, and we're coming into support. There's some rough support around here, and we're at the UK European close, 430. Now I'm saying, you know what? I'm building a picture. Like if I want to trade this type of mean reversion environment, I've got an idea that where I want to go. We're about the distance away from the VWAP we were to the high side. Now it's the downside. We're at support, even better. And we're at the time of day. We talked about time of day a couple of webinar sessions ago. Super useful turning points where things start to shift. I add those together. I might say to myself, that's worth a trade. I like that idea. And the fact that we have that distance and we have now add sort of confluence, if you like, we get a little bit more conviction in the trade. And actually, if you look at this the rest of the day, we almost kind of did exactly the same thing. So I'm putting that on VWAP about the same as the high side. So if you're looking for a target, would you start to look for more? You probably wouldn't. You'd be like, hey, this is about right. Now, when it starts to shift later in the day. It goes above there. It says about this is the other rotation here. And then it breaks out. You might be like, hang on a second, the game's changed. Either that's good for you or bad for you, and you adjust accordingly. But these distance away from VWAPs are super, super important. The right day type, even kind of from this scenario here, where you've kind of got this move here. What's this? 111 points. What's this here? 111, 13, 14, 15, whatever. Close enough. Slightly different day scenarios. So the context maybe plays a bit of a key role in here. But it struggled at the VWAP. It struggled there. And then it rolled back over, and then it happened to be a confluence with, the low of the day, happened to be a confluence with reasonable resistance at a key level from yesterday. What's the duration of, what's the excursion here? It's a little bit more. It's about 100 and whatever it was, 20 or point. It's about right. Now, would you really want to force the short day? No, I don't think you would. You'd be like, okay, if I'm taking the short from back here, I might want to trim because I don't know yet. We're going to have this. Don't forget, with the hard right of the chart, we don't know, but it's acting in accordance with the rhythm. There's a rotation there. And then later on, when the whole thing breaks, doesn't come back to VWAP at all, struggles, maybe that's a game on for you, volatility breakout traders who might say, hey, I'll short that low because the rhythm's changed. Just like the first example, the duration of rotation has changed. Now the distance from VWAP changed. It did bounce initially, but we didn't get to kind of rotate back up as we might expect if we're fully rotational day. We start to go. Now, the name of the game here, guys, is to really, do what you can to decipher what's going on. And, maybe some of these tools help you. Maybe they're not for me. That's fine. But have a way of identifying the conditions, the environment, how to trade it, how to time your trades. Like you see, it's never going to be perfect. You're never going to get it right all the time. But you kind of want to have a way that you are out in the ocean. I think that's a great analogy. Out in the ocean, you're seeing those waves, you're seeing the swell. You're like, okay, we're starting to get like three big swells coming up. I need to move back to catch this wave. If I'm too far in, too far towards shore, I'm going to get mashed. So you calibrating. That's the same thing here. Look at what's happening now. People don't do this enough. And fine, it don't bother me. I don't mind either way. And I say you, I don't mean you, by the way. I mean others. They don't. Maybe you know what? Maybe they are. Maybe there are funds who are absolutely smashing it, who are doing a lot more of this what's happening now type stuff. I don't know. Does it really matter? No, it doesn't. But there's a certain rhythm that shows itself sometimes, and if you can calibrate to that rhythm, it gives you so much better chance of catching the trade you want intraday. Right. Let's do number 3. Reaction to large candles. We talked about this. Did I talk about it? No, I sent an email out. I send an email out every day. Go to tradersmastermind.com. You can sign up for that. Unsubscribe if it's not for you. That's fine. But I try and do something interesting. It's observation, ideas, psychology, etc. And I sent this out the other day that this is happening quite a lot. So let's include it now if you're not on the email list. What's the price reaction to large candles? Okay, and this is a kind of mapping out. Oh, who's in control here? Like we're doing before the rotations and distance from VWAP, who's in control? What's happening? What's my expectations? What can I use that as a roadmap and a blueprint for what might happen in the next couple of hours? What's the reaction to large candles? When we often have a big range candle in one direction, that's an attempt to change the rhythm, right? Regardless whether it's a continuation candle or reversal candle or appears to be a reversal candle, that is supply demand telling you something, and the market's response to that is very, very telling. That's giving us an indication, hey, something is happening. Here's something unusual. How does the market respond to something unusual? Is it price shifting, or is it just a brief pause and we're going to carry on? And this can be how you adjust your bias in real time, if you like. So let's look at Tesla. Only because it is kind of weird day, it kind of earnings were missed, it gapped lower, and it kind of rallied. Now, if you're watching Tesla at this point, let me try and zoom in a little bit. If you're watching Tesla at this point, it's mean reversion. It struggled at this level here. It's pulling back. You know what's going to happen, right? You're like, yeah, you know what? It's tried. I don't know. You've got no idea it's going to rally. Yeah. Anyone who says they kind of, maybe they trade it, that's fine, good for them. But no one knows. You don't know. However, when things start to shift, you want clues, you want indications, and maybe you can wrap out the rotations, distance from VWAP, fine. But when you start to see things that are different, you want to see the market's response to that. Here's a big wide range candle on the breakout, fine. But what happens to that? It doesn't make any effort to come back, 0 effort. And so the rhythm has gone from rotational, we've gone up, we're struggling, dirty candles, rotating back to VWAP, gone up, looks like it might just struggle, fail back, rotate back, maybe even test lows, to now, hang on a second, there's a 5-minute period in this chart that gives us an indication that something has shifted, something has happened, something is worth paying attention to. Maybe you don't trade Tesla, fine. Maybe it's not your thing, fine. This happens to be on everything you trade, but it just happens to be on Tesla because I remember watching it, I remember seeing this. I thought, you know what, great example for you. And so at that point, even though you might be like, oh, well, it's a classic breakout. Yeah, it is. I'm not going to deny that. Absolutely. If you look at textbook stuff, breaks out, it's got high volume, got a high range. But the market's response to that is not one of let's pull back and retest the high. The market's response is let's do another 5-minute candle. Let's do a doji. That's the best sellers can do, a doji, and then we continue up. And so if you're short, you definitely don't want to be short when there's this, right? And maybe you want to initiate along. Maybe that's the trigger you're looking for. I want to see the shift. I want to see the trend change. I want to see some sort of clue that says things might kick into now volatility expansion, price discovery mode versus the rotational mode that it was in the first kind of hour and 10 minutes or so. So these are the subtle shifts. And then we got this, I wanted to add this final thing here. We've got this kind of big, large range red candle. Is that the top? Is that a shift? Again, these are things to look at. Anything that's out of the ordinary, unusual. As we talked about the rotation shifting, we talked about the distance from VWAP changing. A change. How does it respond to the change? The change here is big down candle. I say big. It's the biggest we've had for until this point here, right? Hours. Hours. Yeah, pretty much over an hour. What happens? the response is sellers aren't pressing, buyers see that as value. And in the next 10 minutes, we push back up to highs. So if you'd expected that to change back into mean reversion, but you don't know what's happening. You know, we're hard to write the chart here. We got no idea. It's going to fill the gap and go even higher. No idea. This could be a fake out, rotation back to VWAP. But when you see, this is how you add all these pieces of the puzzle together. When you see these kind of ignition candles, wider range candles, how does the market respond to that? Well, the market actually goes bid. And when it goes bid, you go, okay, actually, maybe, you know what, that's now something to look forward. That's something to consider adjusting to, or hey, I still think we're in trend discovery mode, price discovery mode. Let me position accordingly, or wait. If you were someone who was looking to short this for whatever reason, like, hang on a second, let me wait. Like I say with the, you know, the markets at the moment, US markets. If you do want to short for whatever reason, I think that's your prerogative. But just wait until you see some sort of selling and the response to that selling. Just like this intraday, bit of selling, what's the response? Now, if it tried to go up and then start to fail, then there might be indication that actually, you know what, there's a mean reversion trade on the VWAP's going to act as a magnet. Is it always going to be the case? No, but there's a bit more of indication than, hey, we've sold heavily. What's the market's response to that? It's gone bid straight away. You know, then these are the little clues we want to look out for intraday. Okay, I think that's it. Let's go back to the final. Let's wrap things up here in the slides, guys. Hopefully I'm making some sense. Right. So yeah, we talked about all these four things. Okay, so your checklist for you. Before each trade, it helps to ask what phase you're in. Are we rotational phase? Are we impulsive phase, price discovery? Are we in exhaustion mode? You know, because whilst all the stuff is valuable, the normal day-to-day bull flags, bear flags, head and shoulders, level breaks, the key to making those work effectively, I believe, is to really understand what type of market environment you're in, the context. We talk about context so much because it's so important. And where are you in the rotation? Have things shifted? How far are we away from the VWAP? What's the recent swing duration, if that matters? If you're in a kind of trend discovery mode like we were on Friday, so I'm losing track of days now, then for different, you don't want to use that. You're like, okay, I'm not interested. I'm interested in seeing how market price responds to big heavy down candles. If it grinds back up, game on. I think we're still in price discovery mode. You know, what's the swing duration? All this type of stuff. Am I trading with the current, against the current, with the tempo, against the tempo? You know, and this is kind of, it's a simple exercise, right? But I feel that many traders don't do it. Many traders miss this piece of the puzzle and are maybe too early. They say, well, I saw this reversal. I say, yeah, but if you looked, we were in 25-point rotations. It took about 25 minutes. We're doing X% breaks to highs. That was the rhythm of the market, and you were just out of tune with the market rhythm. You were just trying to do something that was different. You were paddling too soon. You were paddling too late and wondering why it wasn't working. But actually, if you just waited that and used that as a guidance for your entry, your trigger, then all of a sudden you're using it to your advantage. You're aligning with this. So here's a drill that maybe you could do if you find this of value, is to print off your screen, print a screenshot off of your chart. And I like kind of printing things off and just mark out, you know, the rhythm. Just look, just pencil, don't, here, okay, interesting. How far away from the VWAP? You know, what happened with the large candles? Those things that we covered now. And go back to the markets that you like to trade and just see, because I'm sure you will find stuff and you'll go, that's interesting. And maybe you won't look at all this. Maybe it's not all of value to you. I don't want to overcomplicate your trading. But if you're not quite getting the results you want with things and you may be a little bit out of tune, a bit early, a bit late, then this is something to consider, because it's a simple flow chart that you can run through and say, you know what, I just want to see, you know, if we have a rhythm, do we have a kind of adding it with the time of day stuff we've talked about before, time of day, the rotations, the phases, the distance from VWAPs, if you want to use VWAP, all this stuff. Just how do I map? The question you ask yourself should be this: how do I map the market conditions I'm in now? Context is one thing, current conditions is another. To take away is, can't force the market to move your way. If you're out of tune with it, you're just stuffed. You can learn to be more in tune with the market conditions, and I think you could call that rhythm awareness. Now, there's some strategies that I've given you there to help you with that, but by all means, build up your own. Go through your own process of saying, how do I become better at reading and getting into tune with the rhythm of the market that I'm in? How do I do that? What do I need to see? How do I adjust? You know, and that's a good starting point. I believe it's a good starting point. Otherwise, I wouldn't have shared it with you, right? But if you want to come up with your own, that's fine. But I think it will help you, especially if you're an intraday trader, you're an active trader, you're trying to fine tune stuff and fine tune those entries, those exits. Just taking an extra little moment to say, what's the rhythm? What's the rotations? What are the swings? Distance from VWAP, response to candles. Any clues here that are going to help me position better, going to help me improve my RVR, my expectancy, because that over time starts to compound. You think about just a slight adjustment of getting in tune with the rhythm, rather than being stopped, and then getting it. You're getting it first time, maybe the success rate is 50%, but you got 3-to-1 RVR. That starts to work out in the wash over the week, over the month, over the quarter. And it's a slight adjustment. You're not changing strategy too much. You're not changing the way you trade. You're just adjusting your timing of when you deploy that capital, when you decide to take that risk-based decision. Okay. I'll take a few questions if you have any. If you haven't, that's fine. But hope you find it valuable, guys. Right. Okay. And by the way, if you've got to go, that's no problem, of course. I understand. Next week, we're talking about trading models for busy professionals. So I know many of you have jobs, you have other commitments, you have other stuff going on. And so I'm going to give you some practical trading models, if you like, playbooks that are going to help you if you're balancing work, you're balancing family, you're trying to trade. And so you can keep the consistency going without kind of sprinting and then dropping off for ages, sprinting, dropping off. Because I know that's sort of position that many people are in, many who don't have the opportunity to sit in the screens. Maybe you don't want to sit in front of the screens, but kind of helping you do that a little bit better. And hopefully come up with some ideas to assist you with that. Okay, let me bring you over here so I can see you. Okay, Anthony says, hi, wonderful webinar. Thank you, appreciate that. Do you use, did I jerk then? I think I did. Hopefully it's not my connection. Do you ever use the VWAP standard deviations? Good question, Anthony. No, I don't, but absolutely, you can use those. And here's how I would use those. And this, by the way, is Anthony's talking about bands that you can use on TradingView. It comes with the standard deviation bands, or I think you can use fixed bands as well. I would adjust those for what's happening now. So rather than using them, and this is controversial, I would say, okay, if you want to use the strategy we talked about in the slide, I would say adjust the bands so it fits in with the current price action, then use those bands as help and guidance for when structure is changing, how to time trades. Because I think that will help you visually. And you can actually, there is a, I don't know, is it a native to trading? I'm not sure, but I had it coded up and it's very easy to do. VWAP plus X ticks. And so you can visually go VWAP plus or minus 100 ticks, say, and you can adjust the bands to kind of calibrate to the conditions to help you visually see when the rotations are shifted. That's a good question. Another slightly deeper question. As a naturally defensive person and trader who does often lack drive to act, do you have any skills and drills to help with improving action taking? Do you know what I've done? I'm pretty sure I've done a webinar on this, and I feel a bit cheating to send you somewhere else, but I'm sure I did something similar to this, and it was overcoming self-doubt and trusting your strategy. That might be it. I think there's another one as well of hesitation, but if you go to my website, which is tradersmastermind.com, go to the webinar section, scroll down, overcoming self-doubt and trusting your strategy. That may help you, Anthony, because that's something that a lot of traders struggle with. It's like, okay, do I do this? Do I not? And maybe that will help. Okay, thank you for your question, pal. Gary Portugal says, thanks very much as always, Mark. Appreciate you, Gary. Mark says, Mark, is the 5 minute the way you execute and take triggers, or is it just how you generate the trade idea? Yeah, the 5 minute, and this, here's something to say actually. I get a lot of questions about time frames and stuff, and like I say, take it with a pinch of salt. I don't think it matters too much on the time frame. A lot of traders get so bogged down in I want to use the 4 and the 1 on this and the other. You're trying to make a decision based on price, and price is price, whether it's a 15 minute, 4 hour, daily, 1 minute, 5 minute. Sure, you get more information the lower down the time frames you go. We get that, we understand that, and there's a trade-off. You get more noise, but ultimately you're trying to make a decision based on where you think price could go, why, and what's the risk, or where the stop's going to be if the trade is no longer valid. And I like the 5 minute because that kind of calibrates to what I'm looking for, which is kind of an hour to a day and a half, maybe a bit more depending on kind of the asset class. And that's kind of, so 5 minute fits quite nice with that. But adjust it to kind of what you're looking for and the levels that are interesting to you. If you find the 5 too noisy, you can do it at 60. You can do it for, the price is still price. You just miss out on some of the nuances. And I don't think that and I think here's the thing, and I'm saying this with all the best intentions, is don't get too bogged down in the exact time frame you're using. The information is the information. So what do you need? Do you need to see 5 days worth of price? Because actually 5 days are more valuable, in which case you might have to go to a 15 minute because you want to see the flow and you want to see it coming back. And that's a level from 3 days ago that's valid. Are you only interested in 2 days? In which case a 5 minutes perfect. Are you only interested in kind of working it off some sort of news that came out half an hour ago? In which case your 1 minute's fine. And so I think that, knowing to use the right tool for the job you're looking for is quite important. Now, I know I say this, and I've said before that I think use the same time frame to help you calibrate. Because often if you're flicking around too much, so 1 minute, then you're an hour, sometimes your brain goes, well, that looks different. And so I think that from a kind of experience, from kind of building intuition perspective, better to stick to a high time frame and a low time frame. Me, it's often the daily and the 5. Now, that's not to say I won't go to the 1 minute now and then, or up to the 15, but those are my kind of two things. And I don't think there's any right or wrong there. By the way, I'm not saying you days are the only time frames worth looking at. Maybe it's different for you, but it's just having something that you look at to view and to build the bigger picture and to build the trade idea. Hopefully that's helped. Zach says, how do we know a level is broken? Can we use this? I'm not sure what the question is, Zach. How do we know a level is broken? A level is broken if price has gone below it. It's kind of this binary, right? It's broken or it's not. If your question is how do you know whether to trade the breakout or not, context, what's the response to breakout, that type of thing. Such valuable content, Alison. Thank you. Such valuable content. Thanks so much, Mark. Appreciate you, Alison, as always. Arsenagis, sorry, mate, butchers your name. Using VWAP. What's your main concern if it's going to be bullish or bearish? What's your main concern if it's going to be bullish or bearish? I'm not sure I understand that, mate. Apologies. Mark says, thanks, Mark. Thank you, Mark. Does the chart time frame matter? I assume there are different rhythms for different time frames. That's a good question, actually. The point of, okay, yeah, if you're trading intraday, then 60 minutes is not going to cut it, right? Because you're not going to be able to see the intricacies. So a 5, I think, is good. If you're trading intraday, you want to see kind of what's happened. I think a 5 is good for that. If you're kind of trading over a multi-day period and you want to see the rhythms, then, by all means go out. But I think, yeah, I guess the answer is this. So let's put my flag in the sand here. If you're trading intraday, a 5 minutes is a good time frame to be looking at. Although I wouldn't argue if you came to me and said, I want to trade a 3, but you know what? I don't think there's much difference. It's just calibrating to getting enough information you can make a decision without overwhelming yourself with too much noise. I think that's the trade-off we're trying to take. Another Mark, got a lot of minus. It's the meeting of Marks this evening. Welcome, ladies and gentlemen. Welcome, gentlemen, should I say. There's some ladies out there called Mark. I doubt it. Okay, who knows? Let's not get into that. Right. Mark says, when measuring rhythm, do you do it on a higher time frame or is it on your execution? I normally will do it on the time frame that I'm trying to execute on. So I know you're asking me here, and why I'm pausing is because sometimes you might see, I'm thinking back to like an NVIDIA trade where you're mapping out the general extensions away from highs and using that as a rough guideline. Okay, scrap that. Short answer, I'm using on the time frame that I'm executing on. The problem is, guys, and apologies for this, I always think of these edge cases and this, that, and the other. And obviously, if you're asking a question, you're like, listen, you just want some sort of guidance and broad idea, right? So, yeah, here's the answer to that. Well, I believe the answer to that is use it on your execution. A few more questions. Antonio. Hi there, Antonio. Hi, Mark. According to your experience on fast markets like the NASDAQ, or gold. Are there any specific times of day where, after some noisy price action, the asset tends to move more smoothly and directionally afterwards? Hey, do you know what? I literally wrote an email about this, Antonio. Let me recap the main thing. So, standard stuff, mate. Really, European Open for gold, US Open, obviously, data. 4:30 UK times when the European markets close. You often get a shift. 6 o'clock UK time. Under normal conditions, we're 1 hour out sync at the moment. Often we get a shift in the markets. You've got the COMEX settlement on gold at 6:30. That tends to then drift in a direction. So it's just knowing kind of the intricacies of your market, the opens, the closes, the settlements. I know a lot of this stuff is 24/5. So if you're trading with Pepperstone, these things are offered around the clock most of the time. Understanding that the futures, underlying futures, when the options are open, this type of stuff tends to create more volatility and more adjustment. You should ask the same question again. Sorry, Anthony. Antonio, hopefully you got that. Thomas says, thank you, sir. Appreciate you. Thomas Robert says, hey, Mark. He did say, hey, Mark, and I clicked something else. Hey, Mark, according to your experience, no, that's exactly the same question. Apologies. Thanks for the webinar. It was great. Thank you, Robert. Any tips or tricks on deciphering whether ranges are accumulations or distributions? Higher time frame context for that. So if you've broken into fresh territory and you're kind of, you're building a range there, you kind of say, okay, well, actually, maybe this is just a pause for a future leg higher. Is it in the middle of a range, in which case no one really cares? Or is this more a case of buyers backing off, looking around, going, can I get a better price? Is anyone going to sell this? It's trading 100, 99, 98. I'll wait, all back 100, and they have to step up. So higher time frame context, I think, is important there. Mark says, hi, Mark. Hi, pal. I think you might have missed the question there. I guess I lose calibration. This is a response Mark is saying to the calibration question of which time frame. He says, I guess I lose calibration when I use the daily and the 5 minute only. As it comes to the daily level, I might short it a few hundred times, thinking it will reverse because of the 5 minute, but then it reverses 3 days later, but I'm too zoomed in. Yeah, that's common. I think that it's, by the way, you didn't ask for this, but something I would suggest is think of trades and sequences and ideas. If your ideas are reversed off a key level, allow yourself 3 bites of that cherry, no more. And then if it doesn't do it, you wait for the next sequence, which is either let it break out or move lower, let something else happen, and then the trade idea. Too many great traders have kind of fallen into this thing of timing is just a little bit out. And you're doing it. Before you know, you've lost 10 or 20 R on a trade. You only risk 1 R. It's the same idea. So something to consider is to think in sequences. Hey, it's coming to test this level. I'm trading for a bounce off it. I'll take it a couple of times. If it doesn't happen, I need to leave it, let it do something else, whether it bounces off, retest, whether it breaks for a low. What's the next sequence after that? A couple more questions, guys. Hi, Mark. As a swing trader, another Mark looking for 3 or 4 day momentum bursts. And I have to say 10 candidates to possibly trade. I have to look at 10 candidates to possibly trade, but just want to execute in 1 or 2. What would be 3 top criteria? Good question. Institutional ownership above 60%, etc. Triple digit earnings. Great. For me, none of that. None of that, Mark. For me, it's maybe I'm old school with this. Eyeballing the chart. What looks like a good chart that I feel I've got a read on? Is it a trend that I want to buy a pullback in? Is it an exhaustion move that I want to kind of wait for and pounce on? Is it a trading range that I quite like to trade? To me, that's it. I know a lot of people do filter by all these kind of different things, and maybe you could filter by, short flow, etc. I'm not saying don't, and obviously you need some volume and stuff. But for me, it's eyeballing the chart. It's like, do I like this chart? Is there a trade potentially setting up that I can get my teeth stuck into? It's not, it's not quantifiable, but that's what matters to me more. And maybe that help you out. I think that's it, ladies and gents. I think so. Apologies if I missed some. There's a few kind of rattling through, and I appreciate your feedback. Of course, I do. Thank you so much for your comments, support, ideas, suggestions, criticisms. It's all good stuff. So yeah, got a lot of stuff coming on the rest of the week. Keep your eyes peeled, keep the risk managed. As always, I say it because I mean it, and I'd like you to keep your risk managed and live to fight another day if things go wrong. If things are going right, then great. That's the idea, name of the game. Good trading, ladies and gents. Thank you so much. We'll see you again next week. Take care. Bye-bye.